Actually, this portfolio shows some common errors. So let's run through them and how things should actually look and be done instead. So, yes, you've got Apple. Great. No complaints there. But then that's it. You've got a series of funds, which, again, the Cube, which is tracking the NASDAQ, if that's a long-term hold, no issues there. But it begs the question, what are the others selected on? Spiders, Trust Series. If we look and deep dive into these, and you've got the high income, but what's the point of high income if it can lose 12% in just 6 months? Or what's the point of equity premium income if it's only making 1%? Okay, so the point that arises with these is several. First of all, the investment trusts are often chosen on keywords and names such as income, but they don't often match what's on the tin. Now, should JP Morgan Invesco be done for false advertising? Possibly. That's a separate issue. When we drill down to what's actually held in those, it's often, in the case of equities, it's often up to 50 to 100 stocks. So if you did want to have more Apple, for instance, or Microsoft or Amazon or Costco or whatever else it might be, you're not going to get it through owning those because you'll probably end up owning 1% of those. And given that you've got, say, 5 funds, you could have up to 500 stocks and therefore about 0.1% of a stock you want in that. And all those things tend to worry me. So let's have a look at how I think things ought to be done. So we'll come to funds in a second, but if we're looking at individual equity part of your portfolio, I believe you should be vetting at least 10,000 equities because you want the best of the best of the best. And when you look at a narrow range, statistically, you're highly unlikely to be able to filter down to what might be the absolute best. And so people tend to run on name recognition and so forth, none of which helps for performance. So once you've got that data set of 10,000, what are the things that I suggest one ought to look at? Well, the valuation of a company, because we know companies move on value, but we know it's not the only factor, and sometimes there are other factors such as growth. So we should look at value and growth and dividend income. They're not to be equally weighted. Cash return on capital invested, which is a measure of cash flow, because all companies have cash flow statements, profit and loss statements, and balance sheets. So we want to make sure we're ticking all those boxes. And we know momentum can impact share prices as well. We don't want to weigh that too highly. I've marked in green what I think are the important factors. Now, the danger is if you show people just 10 stocks, they will pick one stock out of 10. If you show them 10,000, which is what they should pick out of, they'll probably not bother. And that's just human nature. I ideally want my stocks to be below 20% volatility. I want the Sortino to at least be above 0.3, ideally above 1, but that's rare for equities. And I want them to be outperforming the market, which is the alpha. I keep a very simple flow chart to help people because they often forget. And which is if you've got cash, you first of all determine where your risk appetite is. And I give a weekly update on my Telegram channel to help people determine risk appetite. And then on the whole, I'm usually sitting around here, though February 2022 I wasn't. I was in cash. I was over here. But most of the time, I'm somewhere around here, the S&P 500, below 20%, with a few special situations, smaller cap companies. Once you've got the portfolio, then I'm looking at a 12-month hold in simple terms. And if it drops 25% from the highest it's been since I've bought it, I'd sell as well. And should I turn risk averse during the course of the year, so 12 months isn't set in steel, but usually is what happens. But should I turn risk averse, as in February of 2022, then I'd sell between 10 to 100% depending on the risk appetite. But there's more to it than that, because what we also want to have a look at is exchange traded funds, for instance. And when you look at the exchange traded funds, ideally I want to be picking, because you've picked at funds, I want to be picking, if I'm looking at exchange traded funds, at funds with a volatility below about 12%. Why? Well, why else do you want a fund? Presumably because you want less volatility. We'll probably want them green on 1 month, 3 month and 6 month direction, a high Sortino, which is a measure of average return versus risk, and outperformance of the market. So unless they're green across every single one of those bars, I would not be into it. The fact that billionaires and analysts happen to hold certain stocks matters less for me, and I'm looking at 15 to 40 stocks. to ensure I've got sufficient diversification as a rough rule of thumb. And this is from Goldman Sachs Asset Management. Depending on where I am to retirement, that'll make the decision on how much I have in equities or cash, or cash-like funds, i.e. low volatility funds. Okay, that is it in a sort of a nutshell. But if I were to simplify, what I'd say, and again, this is a common mistake portfolio, is there's a lot of funds probably on name recognition which are underperforming. They're not delivering on the kind of returns you'd be expecting. And if there is an interest in stocks, it looks like there's been too much exposure to equities. And I suspect that you're not getting the returns you want, and you're not taking as much risk as you are happy to take either. Okay, so a couple of factors there. Hopefully that gives you a good overview of what's wrong with the portfolio. Thank you.